See, yesterday we started with this financial context of business one. So we see that from the perspective of organization, individual, and from government, what are the financial aids? So how do they? I mean, what requirements do they have in the short term, in the medium term, in the long term? From all three different perspectives, we have looked into. Then from a business, what are the finances of for the business? So we see that sources of finance in the long term are from basically mainly speaking two different sources. That is, one is equity and debt capital. See, the one which is given as internally generated funds, though they are internally generated funds used for investment, technically speaking, they actually belong to the ordinary equity shareholders. So when we look at the sources of finance, we also look at this one as a separate source of finance. But technically speaking, this actually belongs to the ordinary equity shareholders. Therefore, while valuing the cost of retained earnings, the valuation goes along with the way we value the equity, value of equity or the cost of equity. On similar lines, we also calculate what is the cost of retained earnings. Then, what are the source of finance in the short run? Also, we have looked into, discussed some of the financial products. In the long run, basically, it is about equity and debt capital. The attributes also we have looked into, both from the perspective of the company as well as the individual investors who invest into the company. Then, for the short run, we have looked into certificate of deposits, mortgages, credit arrangements, and bills of exchange. As we go along, when we come across other instruments, we will also look into what are they, what are the attributes also, we will look into that. Today, let's start with the next topic, what is financial markets. In any economy, there is a financial system. Financial system composes of multiple aspects. See, one among them is financial markets. How the financial markets, where the securities are traded, etc. So, this financial markets, we see them as different types of markets again, classified as different markets. See, the financial markets, in that we see that there are broadly speaking, there are two types of market depending on the time period. If the time period for converting the securities into cash, it is greater than 1 year, we call that to be as a capital market. If it is less than 1 year, it's called as money market. See, the capital market, the main attribute here is if the maturity period exceeds 1 year. So then it is called as capital market or stock market. But if it is less than 1 year, it is money market. Okay. So what is a capital market? See, capital market also called as stock market. So the stock market acts as a market for trading all the securities for long term. Okay. So long term securities are traded in the capital market or securities market. The stock market acts as a market for the shares in publicly quoted limited liability companies. Then we see new shares issued by the company or by these companies. Then any kind of government and corporate stocks and bonds. So if the government is also selling these stocks or bonds, they are also traded in the stock market or capital market. So the main attribute what we have to remember is the time period is greater than 1 year. Okay. As with all markets, prices are determined by demand and supply. Demand reflects investors' estimates of the prospects for the company. I think in the initial days, initial classes, we've learned about see how one of the parameters by the prices of the stocks go up is about the profitability. So how much profit is made by the company, what are the returns the shareholders have earned, both in terms of the profits that are available per share EPS, as well as how much dividend was paid to them as DPS, EPS and DPS. Now it says that as with all markets, prices are determined by demand and supply. Demand reflects investors' estimates of the prospects for the company. If their profitability situation is good, if they are paid better dividends, they are satisfied. When they are satisfied, they hold the shares with them. They do not think about selling them. When there is a shortage of supply, then when there is demand for these shares, then we see that the prices are also increasing. But if there is dissatisfaction among the shareholders, they are not interested to hold these shares, but rather sell them in the stock market. It indicates that the demand for the shares has decreased. If the demand has decreased, then we see that the prices also fall for these shares. Okay. Demand for shares also reflect yields. Yields on bonds are determined by the prices and the rate of interest. Yesterday also there was one question where we have looked into when interest rates in the market fell. So we have on a comparative note understood that because the market was not able to pay as much as what the company was paying, so the company's bonds were demanded more. When the company's bonds are demanded more, the demand for the bonds increase. When the demand increases, the price also increases. So here, this is an exception to law of demand for the capital markets, where whenever the demand for the securities increases, the price of these securities also increase. Okay, stock markets provide long-term finance and are part of the capital market. Money markets, as we have looked into, the main attribute here is less than 1 year. See, acts as a market for treasury bills, commercial bills, certificate of deposits, and other short-term debt. Financial institutions, we see financial institutions, commercial banks. The main functions of commercial banks are, see, in the if we are talking about the financial system of an economy, as part of financial system of an economy, we see that there are financial markets, one thing. Then there are financial institutions. So the next aspect of it is financial institutions. So as part of the financial institutions, we see banking companies and non-banking companies. So now banking institutions are there. Banks are part of the financial institutions. We see certain other organizations also providing finances, but they are not banking. See, of course, we also have the unorganized sector providing finances to people in the economy. But if we talk about the organized sector, under the organized sector, we have the banking system. So as part of the financial institutions under the financial system, we see that commercial banks play a very important role. What are commercial banks? Commercial banks accept, see, there are certain characteristics of commercial banks, of the functions of commercial banks. What are they up to? The first thing, these are all general things which we also are aware of these things. See, the main functions of commercial banks are accepting, safeguarding customers' deposits in current and deposit accounts, transferring money from one account to another via the clearing system, lending money in the form of loans and overdrafts, facilitating trade by financing trade credit. Overall, these functions are concerned with financial intermediation. Intermediation is they act as a mediator. That is intermediation. So, what are they doing? See, there are people in the economy who have incomes available with them. So, there, on the other hand, we also see that there are producers, manufacturers, people providing goods and services requiring these funds. There are people who earn money, who earn income, and they have some available savings with them. So the banks collect these amounts from various individuals or organizations. So first thing is they accept safeguarding customers' deposits. So they accept deposits from multiple people. These funds are all pooled up. Then there are, on the other hand, we see that there are people who require money for carrying on with the productivity activity, the production activity, production of goods and services. So here they play a role of an intermediary, wherein they connect, see, by collecting deposits from multiple people and pooling it up and then providing these amounts as loans to those that require. So it is the role of an intermediary. So overall, these functions are concerned with financial intermediation. Now, commercial banks and credit creation. See, banks can create credit in the form of bank deposits. This is because experience has shown banks that on average, customers will only require a certain portion of their deposits in cash in any one period. So that would be the cash ratio. Um, See, the customers who deposit the money all the time, they do not require all that amount, whatever they have deposited. Maybe from observation also we understand that they require only one part of the deposit. Even if they withdraw also at one go, they would not um, clear the entire amount that is deposited. So maybe they use only one part of the deposit amount. So in that case, to that extent, so maybe a particular percentage of the total amounts that are deposited, if they are required by the customers to withdraw, to that extent some amount of cash balance is maintained by the bank. The rest of it can be used for lending to others. Okay, thus a deposit of cash can act as that portion required in total deposits, um, that is credit granted can be increased by a multiple of the original deposit. This is known as credit multiplier. Just a second. Um, I'm really sorry. Bear with me. Okay, sorry. There was some message which was popped up, so I had to answer that. I'm really sorry. And here it says that thus the deposit of cash can act as that portion required, and total deposits can be used for extending it as a loan. Okay. So this is known as a credit multiplier. In practice, this ability is limited by the behavior of other banks. One bank cannot operate at a lower cash ratio than others. So, so who decides how much ratio should be maintained? So, um, it is the central bank. See, every economy, every country has a central bank. So for us, we also have a central bank here, the RBI. So they decide on how much cash reserve ratio has to be maintained. The central bank may limit the amount of cash in the system or may raise interest rates, making customers less willing to seek credit. Then we've discussed yesterday that see, in the long run, there are two main sources of finance. One is debt capital and the other one is equity capital. So what is yield? Yield is the current period, what amount of return is earned is yield. Okay. So in case of bonds, see what is earned on bonds, the interest amount is earned. So as against the market price of the bond, what is the annual interest rate, current interest rate on the or current yield, what we call it as running yield or current yield. See, if this is the investment, the current investment on the bonds, if this stands at 100%, this is the selling price in the financial market or the capital market. If this happens to be 100%, the interest amount is what percentage? So the equation is annual interest by market value into 100. It is only talking about the current return. See, return is basically of two types. If we categorize them, classify them. See, what they can earn in the current period is one part of it. What they can earn over the entire lifetime is another thing. So bonds have a maturity period. So what is the return that can be earned over a lifetime is another part of it. See, over the lifetime, there would be a difference between when they have invested, um, that is the sale price at the time of issue of bonds, and at the time of redemption, what would they get? So the difference is calculated spread over the number of years. Any other cost like to buy the bonds, if they have spent something else extra, all that also would be adjusted. So some other context, if we have to take it up, we will take it up. But as of now, the return which is earned on the bonds in the current period is current yield. Current yield is the annual interest divided by the market price that is prevailing in the capital market for these bonds. So annual interest by market value into 100%. So this is only the return in the current year, but over a lifetime of the bond, there is another equation. Just remember that. Similarly, if we are to calculate yield on equity, what's the current yield on equity? Dividend yield is equal to what's the amount of dividend that is paid divided by the share price, the present prevailing market price of the equity shares. So the dividend that is paid, DPS, by the other day we've done a question also on what is dividend yield ratio. Dividend yield ratio is equal to DPS by MPS, market price of share, into 100. Then we see central rate is equal to rate at which central bank lends to money market. Lenders adapt central rate to incorporate risk and maturity. Um, Lenders normally demand higher rates for longer lending periods. Here if we are talking about the bonds, how to decide what is the amount of interest which has to be decided. See, at the time of issue, the interest rate is decided by the company, and that interest rate will prevail. But what is the parameter? What is the criteria which will be taken into consideration to decide how much interest should be paid on the bonds? So that is normally decided by the central rate. So central rate is equal to rate at which central bank lends to money market. So whatever is the prevailing rate, see, for every economy there is some rate which will be considered as the appropriate rate to be paid on the investments, on the debt capital. So if that is the standard, generally lenders adapt the central rate to incorporate risk and maturity. But lenders normally demand higher rates for longer lending periods. So if it is as the time period extends, the risk aspect also increases. So if it is for the current period, the prevailing central rate will be taken as the criteria to decide on what is the rate of interest. But as the time period extends, what the years to maturity extends, then we also see that the interest rate also increases, the yield to maturity, as the number of years to maturity increase, because for longer period the funds are all blocked there. So if that is the criteria, then it will be taken into consideration at a higher rate. Okay, that is the as the number of years to maturity as it increases, the percentage yield that has to be paid on the longer period on these securities for a longer period also tends to increase. That is yield to maturity. But see, the rate that is taken into consideration, the central rate that is decided, if it is taken into consideration to decide what is the interest rate, then in that case, what about the rise in prices, that is on account of inflation? The prices also rise. So the same interest rate, whatever is decided by the central bank, the central rate, when that is considered, so how would they adjust or accommodate the rise in prices or the inflation rate? Therefore the real rate would be calculated, the real rate after taking into consideration the inflation rate. So real rate would be 1 plus money rate divided by 1 plus inflation rate minus 1. So the real rate has to be calculated. We see that the equation of the prevailing rate 1 plus money rate, this is the prevailing rate, is equal to, if it has to be adjusted for the inflation rate, whatever is the percentage of inflation, that has to be increased. So that has to be adjusted here to increase the rate. So 1 plus real rate into 1 plus inflation rate. So make an adjustment towards that and then consider that rate for future calculation, because the future cash flows are taken into consideration to decide on what would be the return, or what would be the return that will be promised on the debt securities. Then we see, we've learned about the financial markets. Okay, in the financial system, we've learned about the financial markets. Then we've learned about financial institutions. Now it is financial intermediaries. Intermediaries, what is the role of financial intermediaries? See, they play different roles. One, we see that it is risk reduction. So the real role is to reduce the risk, reducing the risk related to a single default. Aggregation, pooling small deposits to provide larger advances. Maturity transformation, satisfying different maturity time scales of lenders and borrowers. Then we see financial intermediation, bringing together lenders and borrowers. So what's the role of intermediaries? See, if there is an intermediary who's present there to help the people in the economy, the borrowers and the lenders, see if in case if there is a default, see, now that would be streamlined. If it is from one lender to one borrower, in that case, if at all if there is a default, see that will increase the risk. Individually, it is very difficult for them to settle that default and then get back their amount. But if it is through an intermediary, there would be certain kind of promises involved in that. In case the promises are not kept, they would be legally abiding. Therefore, for that reason, the intermediaries play a role which safeguard the interest of both the parties. Now, in that case, they act as someone who can reduce the risk reduction. So reducing the risk related to a single default. Okay. Then the second one is aggregation. Aggregation is pooling small deposits to provide larger advances. See, individually, each individual from their individual income, what they could save is a small portion of it. Likewise, from multiple people, when small portions are all pooled together, they are collected, that will become a big amount of money that can be lent to someone who requires large portion of capital. Just pooling small deposits to provide larger advances. Then maturity transformation. What is maturity transformation? It says that different types of securities have different time periods. The short-term borrowings have a short-term time period. So at the end of the period, the amount has to be paid back. Then we see long-term, at the end of the long-term period, the amount has to be paid back. See, the securities, the financial instruments have different time periods. So when there are different time periods, so each of them has to be met. When there is an intermediary in between, depending on the maturity time period, they can be provided with funds so that they can meet their maturity of the financial instrument. Let's say if there is a financial instrument which has to be repaid at the end of 3 months, maybe by then they would not have funds. They may have their cash flows coming in after 5 months. But right now, at the end of third month, there is something which has to be paid back. So here the financial intermediary will provide the funds to the entity, the person, individual, or the organization with the funds with which they can settle the financial instrument which matures after 3 months. But later on, after 5 months, when they have their cash flows coming in, with those cash flows, they can settle off whatever is the amount borrowed from the financial intermediary. So it will help the lenders and the borrowers to meet their financial maturity of different instruments. Okay. Then the main role is that they bring together the borrowers and lenders from multiple individuals. These amounts are collected in small portions, and then they pool up this large amount of capital, and that is extended as loan to the the borrower requiring large portion of amount. Okay, so that's the main role which they are playing: financial intermediation, bringing together both of them, lenders and borrowers. Now, can we deposit taking institutions such as banks and building societies, or non-deposit taking institutions such as insurance companies, pension funds, and investment trusts? All of them play this role of financial intermediaries. We know anyway banks play that role. We see there are building society, housing corporations and all building societies. Then we see they do not collect individually. Nobody can deposit amounts into insurance companies, but they have their policies and sketch, and then they have their schemes wherein they collect funds from the individuals, they pool up the money and on behalf of the individuals, they invest that. So when the returns are earned, those returns are paid off to the investors, but it is not directly depositing. As and when they have surplus funds available, they cannot deposit with the insurance companies or pension funds. Of course, pension funds also, there are certain schemes which are available, given by the government. So anytime whenever they have surplus funds, they can think about it, or um, according to a particular pattern, they can deposit those funds. So pension funds and investment trust. So uh, see, these people, these entities play the role of financial intermediaries. So they take up this role of intermediation, acting as an intermediary between multiple lenders and borrowers. Then we see what is credit creation. How do they create the credit creation? The change in total deposits is equal to multiplier into initial deposit. See, how do they create credit? See, initially there is some amount of initial deposit that is multiplied into the multiplier. So that will be change in deposits. But what's this multiplier? Multiplier into 1 by cash ratio. How much should they be maintaining it as a cash ratio? So some cash balance has to be maintained by them. The balance of it can be used for issuing it as a credit. Um, yeah, the total deposits, initial deposits are 100%. So out of that, let's say if the government says that retain 20%, for example. So 20% of that would be retained by them. The balance of it can be used for issuing as loans to others. So take the multiplier, take the percentage which they can use to issue the loans to others. So multiplier can be calculated as 1 by cash ratio. The balance of it can be issued as loans to others, 1 by cash ratio into the initial deposit. Now, what's the central bank? See, the central bank is a banker to other banks and the government. So now they have the policies and regulations laid out for other financial institutions. So, like other banks, they are a banker to other banks. So, banks also can deposit and borrow from the central bank. For us, it is RBI. They also take decisions on behalf. So, whenever governments also require funds, so on behalf of the government, also central bank takes decisions. So bankers to other banks and the government, then they supervise the entire banking system. That is also that they supervise the entire banking system. So when we study about what are the functions of central bank, then we get to understand these things. We'll try to answer a few questions from this section, after which we can come back to this one and then talk about the macroeconomic and institutional content at number one, that is the domestic economy. So what are the what is the scenario situation in the economy as such? So we would be looking at a macro level, at the economy level. So we will be looking into what is macroeconomics. Certain other aspects of it also we will look into that. But let's first take up few questions and then try to answer those questions and then proceed further. 1 second, I'll open the file. One second. Let's take up these questions and then answer them. Yesterday also a few questions we've answered. The balance of them we will answer it now. Um, Question number 66 is done. Question number 60. Uh, '68. Which of the following is never an asset of a clearing bank?
Customers deposit account, since it's customers asset account.
Okay, so clearing, never an asset of a clearing bank. Customers deposit account is a
Never an asset of clearing bank, since it's a liability, it should be paid back.
That's right.
Yeah.
It is a liability for the bank. But
Bank.
cash is their asset if they have extended loans to others, if they have maintained balances with other banks. If the reserve asset ratio was 25%, how much money could a bank create from an initial deposit of 100%? Now, how much credit can be created? So that is that's the concept here. How much credit would be created? Initial investment is initial deposit is 100. So what is the formula? Let's just look at the formula once. The cash. The cash ratio is given to us already 25%. Multiplier is 1 by cash ratio. Take that 1 by cash ratio as multiplier into the initial deposit of 100. Just do the calculation. 25%. So, is the answer 400?
Yes, ma'am. 400.
So the multiplier will be 1 by 0.25. So take 1 by 0.25 into the initial deposit of 100. Take that. Good. Lenders normally want to lend funds for a short period of time, but most borrowers want to borrow funds for a long period of time. How would you describe the solving of this mismatch? Okay, this will be called as. See, there are different maturity periods. So, if there are different maturity periods to meet the requirement at the maturity time, we see that arrangements are made for to repay the amount at the maturity time. So that would be called as pooling is collecting deposits from multiple people. Aggregation, collecting all of them and then aggregate that pooling and then looking into how the aggregate amount can be extended as a loan. And then risk reduction is individually if there would be a default, if there is a borrowing and lending happening between two individuals, that can be resolved by risk reduction because there is an intermediary acting and taking care of the default issue of individuals. Maturity transformation is see when there are different maturity periods at which the cash flows are not available. Therefore, the intermediary provides the funds at that maturity period and manages that. So that would be called as maturity transformation. 72 says, what is the main reason that borrowers and lenders are unlikely to contact each other directly? Lack of communication systems, high cost.
High cost.
Financial intermediaries are only open for a limited amount of time each day. They are unlikely to have assets that can be traded. The communication systems, there is nothing like that they can communicate, but it is time consuming because there are multiple people with small amounts of deposits. So approaching individually each one of them is a lot of time taking, and it is costly also. Contacting so many of them with whatever is the mode of communication through whichever medium, see, it would be definitely time consuming and high cost. So on that note, we can go with high cost. C says if financial intermediaries are open only for a limited amount of time each day. Nothing like that. They are available. Um, see, even if that is the reason, whoever requires the funds also, they can approach during those time periods. It is about not that is the main reason why they approach the financial intermediaries. See, even if there is a banking institution available open during a particular time period during the day, um, for that reason they are not approaching. They are approaching financial intermediaries because of the total amount of borrowings which they can borrow from one source, one single source. Wherein if they were to collect the amount from multiple locations or multiple people, they have to collect these funds. That is time taking and costly. Okay, then the fourth one is they are unlikely to have assets that can be traded. The main reason why they would borrowers and lenders are unlikely to contact each other are directly is because of high cost which is involved. What is the main way of distinguishing between capital and money markets? The time period is the main point of difference here. If it is great, if the maturity period is greater than 1 year, it is a capital market. If it is less than 1 year, it is a money market. That is the main point of difference between these two types of markets is the time period. So we see that transaction cost, the amounts involved, the time to maturity, and the amount of risk. Which of the following does not engage in the buying and selling of shares in other companies? Unit trust, investment trust, pension funds, and then stock exchange. Unit trust, investment trust, pension fund, they collect funds from multiple investors. They may not be collecting deposits, but they, by way of selling their policies, their plans to the individual investors, they pool up the money. In turn, they invest into various securities, into shares and bonds of various companies. They have their own portfolio wherein a portion of the amount is invested into different types. Some of them high yielding securities, some of them low yielding securities to safeguard the investment. The high yield or high return securities also have high risk. Low yielding securities have low risk. To have a balance between the risk and return, they take decisions, they create a portfolio constituting multiple securities into which they invest the amount. And they earn the returns, and these returns are distributed to the individual investors. This is what is done by all of them: unit trust, investment trust, pension funds, etc. But stock exchange is a place, it is a financial in the financial market, it is a place where the securities of different companies are traded there. Stock exchange does not buy and sell shares of other companies. It is a place, it is in the financial market, it is a place where the trading of securities happen. 75. Which of the following statements is false regarding ordinary shares? They carry higher risk for the investor relative to bonds issued by the same company. Dividends are paid at the discretion of the company. Unquoted company shares are less liquid than those of quoted companies. We see ordinary shares are redeemable by the company at the discretion of the investors. So ordinary shares are ordinary equity shares. So something is wrong about the ordinary equity share.
Ordinary share, yes. It is not redeemable at the discretion of the investor.
It is never redeemed as long as the life, as long as the company exists. During the life of the company, they are never redeemed. So ordinary shares are redeemable by the company at the discretion of the investor. That is not a possibility at all. So that is false. Whereas when we look at the other things, they carry higher risk for investor. Definitely, they carry a higher risk. That is true because the returns are better. The risks are also higher in case of um, the relative to bonds. Why is it risk for the investor? So when we talk about the risk aspect of it, see, in situations where there are no profits made by the company, there is no return paid. There is, because the companies are never under an obligation to pay a return in situations where there are no profits. So any unprofitable situation which arises, it increases the risk of the individual investor. So that is the truth. Dividends are paid. So there is, since there is no obligations, even in situations where profits are available, also the companies can take a decision of not paying any dividend. So that also increases the risk. So that is true very much. Then C says that unquoted company shares are less liquid than those of quoted companies. Because quoted listed company shares can be very easily traded in the stock market. So we see that better prices are there as compared to unquoted company shares. 76 says that which of the following is not a function of the World Trade Organization? World Trade, we didn't discuss anything about World Trade Organization. Maybe I can put it on hold. I will discuss something about World Trade Organization. Then only we can answer that. Without discussing anything, it is not appropriate. 77. Let's look into what is the 77 question. Assume that the current market rate of interest is 5%. The government is issuing new bonds at 100 each, offering a yield of 5%. If the market interest rate fell to 2%, what would be the maximum price a retail investor would pay for the bonds? How much, what would be the rate which would be paid? See, we have looked into what is the current yield. The current yield formula is the interest, the current market interest rate divided by the market price of bonds. The current yield is equal to annual interest rate divided by the market value. So that's the formula what we have. At present, the current market interest rate is 5%. The market price is 100. So obviously, the current yield also 5% because 5 by 100 is 5 by 100 into 100 is 5%. Now, what if the market rate fell to 2%? From 5%, it fell down to 2%. What would be the maximum price a retail investor would pay? So we want to calculate what is the price of the market. So price of the market would be the current interest rate. interest rate is paid.
Now 5% of 100.
Current yield is equal to the formula. Otherwise, this is 5%. Interest rate.
The 5% is for,
Interest rate became. Interest rate became.
$5, which is for 2% of the market interest rate.
It is 2/5 or.
No, ma'am, like the yield would be 5% of 100. That is $5.
That this part of it is fine. If the market interest rate, the market interest fell down to 2, so this becomes 2%. What and
to earn that $5, like at the market rate of 2%.
This is what we have to find out. See, we have to find out the maximum price of retail investor. So
investor would pay, yes.
So price goes here, CY comes here, current yield comes here. Price is equal to interest divided by the current yield. What fell down? Current market rate of interest fell down to 2%. Current market interest rate fell down. The numerator is 2, denominator is
Ma'am, since it's 5 interest, 5 divided by 2%. Then it will be.
we do not the current yield is a percentage of let price be if we take it as x. If this is x into CY by x. No, I don't know. So the interest rate would be okay. I don't know what's the logic.
Ma'am, can I try?
Please.
I believe for the $5 is the right answer for the yield which we get. And I believe it's like for $5, to earn that $5, the market interest rate is 2%.
Okay.
And the investor would have to pay how much is the question. So maybe like 5 divided by 2, like the normal cross multiplication type. Like $5 and 2%. And then for 100,
I'll make you a co-host. You'll scribble on the screen. I'll put it. I don't know. Somehow logic is not striking to me. You scribble on the screen. I'll erase the entire thing.
No, ma'am. I'll just like even I don't know if it's right or not.
No. Somehow it's not striking me. What's the logic? This is the equation. The way we calculate current yield, see current yield, right now there is an yield of 5%. So when there is an yield of 5%, that is by taking the interest rate, current interest rate divided by the price. As of now, the price is at 100. So $100 at which the government is issuing. But then because they are traded in the securities market, the price keeps fluctuating. How does the price fluctuate? So price will become interest rate divided by the current yield. So if interest rate is 2%, 2%, okay. So this will be 2 only because on the face value interest rate will be
Yeah.
calculated. I will be 2,
Yes.
okay?
2%.
2, if I is equal to 2, price into
No, ma'am. The first I'll it will be $5. What I'm saying is 5% of 100 rupees. That is $5 will be the yield we earn for 2% of interest rate.
interest rate is the market interest rate fell to 2%. So that
2%.
should be current yield. Yield is 2%. Interest will
Yeah,
continue to be 5% only.
5%. That is yeah,
Then price is what?
and
The price is equal to 5 by 2. Okay. What's the answer? 250. Interest is a fixed percentage on the face value. Face value is 100. 5 into 100 is 5. The current yield, which was earlier 5%, now that yield fell down to 2%. So
2%.
we see 5 divided
5
by 2,
by
which
2.
is equal to 2
Yeah.
into 100.
Yes.
Okay. Now we'll move to the next topic. Until now, we were looking at the macro level. See, all those topics what we have discussed were at macro level, right? Now we need to move ahead and then look at the macro level. See, until now we have discussed about macroeconomic and organizational context. But from the economy point of view, at the economy level, what are the issues is what we will be now focusing on. Macroeconomic and institutional content. One, the domestic economy. As part of that, we would be looking into what are the policy objectives, what objectives do the government have, then policy options, circular flow of funds, aggregate demand and supply, inflation, unemployment, trade cycles, managing interest rate risk, and other aspects. See, what are the policy choices, policy objectives, um, uh, any particular, the government in an economy have. See, the main objectives of economic policy. See, every economy, the ruling government has certain objectives, certain policies are made, certain objectives would be there, based on which they carry on with the operations. So the main objectives of economic policy are, the first one says it is full employment, to provide employment to all. See, for each country there are different things. For us also we have so many employment schemes where they are named as the Pradhan Mantri Rozgar Yojana or something. See, each state also has its own set of policies, like minimum of so many days work should be provided. They ensure that everybody has some, at least one part of the year they have some work. So some kind of schemes and policies are made to ensure that people are provided with employment. So when employment is provided, they will have a way to uh, create or generate income for themselves. So one of the objectives of the government is to provide full employment. Okay, then we see price stability. See, if the prices are not controlled. See, the other day we've discussed about how the government intervenes, even if it is not beneficiary, if even if it is not price equilibrium, um, still the government intervenes and then decides about what should be the maximum price, what should be the minimum price. In other situations, if it is regular trade which happens, we see that so here we see that um, there is a role of suppliers. Um, Sometimes because suppliers want to maximize the profitability, so depending on whatever is the scenario of the demand and supply, prices are accordingly decided, but that may not be beneficial for the people in the economy. So to for the benefit of the consumers, for the sometimes in certain situations even for the benefit of the suppliers also, government intervenes and decides what should be the prices are stabilized. So that is an important aspect. If there is no control of the government, the prices keep on rising because it is beneficial for the suppliers, because they want to maximize their profitability. They tend to increase the prices. So they may create certain things like artificially there is some kind of a scarce or shortage created, or some kind of means wherein they ensure that the prices rise. See, if at all, if the government does not intervene, the prices keep rising. That will be the result of, that will again result in inflation happening. Okay, the avoidance of inflation, to avoid the inflation, there is price stability. Okay, also to see that the economy grows year after year. What is the economic growth? Growth is must for every entity, for every economy, for every individual and an organization. Also growth is inevitable and must, and it should happen. Okay, so at an economy level also, growth has to happen. So then equilibrium on the balance of payments. Equilibrium, one second. Sorry. Equilibrium on the balance of payments. So what is balance of payments? Um, when there are when trade happens, trade is an activity of buying and selling. So in when buying and selling has to happen, um, there is we also see that there would be imports and exports. So then the payments have to be made, the amounts are to be collected. So there should be a balance of activity that has to happen. So equilibrium on the balance of payments, that is another important aspect of any economic policy. An acceptable distribution of income. Acceptable distribution of income. See, if there is no control, then we see that people who have lot of ability to earn money, they continue to generate more money, and the rich become the richer and the poor become the poorer. So that is one danger which we can see here. So the income that is generated, it is distributed equally among the people of the economy. See, depending on the other parameters, it is to ensure that there is a possibility to generate revenue. There is a possibility for people to generate revenue is what is important. So an acceptable distribution of income is what is needed. Okay. Then, but governments may differ over which objectives are the more important. See, all of them may not have a priority given to the same set of policies, depending on each country, each government, and their policy. Weightage is given to different objectives. So, which objectives are the more important? What constitutes an acceptable level of unemployment, rate of inflation, distribution of income, etc. Okay. In some of the countries, maybe the unemployment rate is quite high, so they may focus on providing employment to people. Maybe in countries where inflation rate is very high, their priority can be towards controlling the inflation, etc. So depends on each country, but these are the broad areas where they focus on. Okay. So what constitutes an acceptable level of unemployment, rate of inflation, distribution of income, etc. It differs from country to country, government to government. Okay. All of them, it says that all of them may not be achieved at the same time, but we see that there may be trade-offs between objectives. There is next topic called as circular flow of funds. Circular flow of funds. There is a simple model of circular flow. See, we see that there are two entities here. We see one is a household, the income generated by households, and we see on the other side, we see firms. What are firms up to? They are involved in providing goods and services. So there is some activity which is carried on by the firms. So people from individual households contribute their labor, they contribute their efforts to the firms. So they are involved in the activity of the firms. So by contributing their efforts, contributing their labor, they are contributing towards the production of the goods and services in the economy. Okay. Then income is generated by both of them. See, income is generated by the firms. It also provides a source of income for the individuals also as part of the household. So individuals work for the firms, they contribute their effort, or they contribute their labor to the firms. Firms in return will provide goods and services, so they can generate revenue. They also help the individuals also generate revenue. Out of the revenue that is earned by the individuals and by the firms, they are involved in spending. They spend. Okay. We see that there is a definition given. Equilibrium national income is where the level of income in the circular flow is constant with no tendency to rise or fall. Here income and expenditure will be equal. So it goes with an assumption that the circular flow of funds goes with an assumption that all that is generated as income during a particular period is all spent. There is nothing saved. There is nothing which is remaining. Now here we see that all that is generated as income would be spent. So equilibrium national income is where the level of income in the circular flow is constant with no tendency to rise or fall. Here income and expenditure will be equal. Okay. So at this point of time, there are certain withdrawals and injections made into this circular flow of funds. What is a withdrawal? So it says that a withdrawal in the circular flow is any income received that is not passed on in further spending in the flow. Then withdrawals are, we see different categories of withdrawals where, see, now we start with an assumption that all that income that is generated is already spent. So if at all, if they set aside some amount as savings, so here that would be taken as an withdrawal. Withdrawal is a portion of the income is separated from here. So otherwise, now the people work here for the firms. Firms in return produce the goods and services. They generate income. They also allow the individuals from the households also to generate income. Now they spend completely because they have to spend this income on purchase of the goods and services. So they spend their entire income. The spending happens, and the firms, whatever income that they generate by selling the goods and services, are also spent because they have to reinvest the amount into the production of goods and services, because they have to pay wages to the or the returns to the individuals who contribute to the work, and then they have to reinvest, etc. Now, here in this particular concept, when we see that there are withdrawals is where some portion of the income that is earned is set aside as savings. Then some portion of the amount is paid as tax. Then we see that any amount of imports that are taken up. So these are all withdrawals. Then on the same note, then we also see that there are injections. What are injections? An injection in the circular flow is additional spending from outside the circular flow. See, otherwise the circle is only limited to this part of it. Apart from this, the withdrawal is something which is taken out of this. That is a withdrawal out of this circular. If there is some saving, some tax, some imports which happen, which go out of this circle, is withdrawal. But something injected into that, so that comes into the circle. Now that injection could be an injection in the circular flow is additional spending from outside the circular flow. Injections are investments. Additional investment can be made, okay, taking it from other sources. So additional investment introduced into the circular flow. Garment spending. So then export. So bringing, the way imports are taken, so some part of it which is part of the circle is taken out as an accelerated growth in income. Growth in income is given by a variable called as Y, results in growth in investment. Okay. See, if the income increases, growth in income by results in growth in investment I, and there is an accelerator. So what is now how do we calculate that multiplier? So the multiplier, net injections, that is extra I, extra investment, results in growth in incomes. That is why. So because of additional injections, that is additional investments, um, government giving something or like grants or subsidies or something which comes into the picture. When they export the goods, then there would be additional revenue that can be generated, exports which come into the picture. Okay. So that is injected into the circular flow. So net injections result in growth in income. So we see that the multiplier is calculated as 1 by So let's just see the explanation from the study text. I will just put you. One second, let the page open. We can look into the explanation in clear from the study text which we have. One second, let me just open this. It is not, it's showing blur. We will try to understand it a little better from the study text. Sometimes when we wait for something, the file to open, it doesn't open. I open in another mode. I have opened in another mode. This is PDF format. So the circular flow of circular flow model talks about. So there are individual households and there are firms. So firm households contribute their labor towards the working of the firm. So wherein the goods and services are produced, and these goods and services are sold, and when they are sold, the individuals of the households purchase them. So by consuming these products and services of the firms, they generate income. So income is generated by them. By selling them, income is generated by the firms as well. So now we see that that is the circle that is happening. Now this circular, by consuming, they are uh, generating revenue for the firms, and then firms also pay in return to the households because they have contributed their work. So there are withdrawals. Withdrawals are when we see that there are savings. S is one thing, savings happen. So from this circle, something is taken out and invested, saved. So that is saving. Then we see M is imports, when they um, import something from outside, so they are bringing into that, and then for that the payment has to be made, so it is going out. Then we see taxation has to be paid. Similarly, something has to be injected into that. Injection part of it, we see that the grants from the government, role of government is there. Then we see that investments are made, injected into the circle, and we see exports. So when things are exported, when the products are exported, so there is some additional revenue that is generated, which is invested in, injected into the circular flow. So this circular flow, it is not necessary that pairs of injections and withdrawals are equal. Equilibrium only requires that the sum of injections is equal to the sum of withdrawals. But if at all injections are greater than withdrawals, additions to the circular flow exceeds. See, if what they have injected is more than what they have withdrawn, in addition to the circular flow exceeds withdrawals, and so the level of national income will rise. So more is pumped into the economy, more is injected into the economy. Additional investments, grants from the government, subsidies from the government, they are injected. So this will result in more productivity, more products and services are produced. So that will result in the level of income to rise. Then on the other hand, when J is less than, injections are less than the withdrawals. So injections are less than withdrawals, additions to the circular flow are less than withdrawals. So the level of national income will fall. Okay. Note that in both cases, the growth or fall does not continue indefinitely. Um, if the growth results from additional investment, then further ongoing investment would be required to sustain it. This issue is discussed. We will see that when we talk about trade cycles. See now here, if we look at that picture in detail, see the circular flow of funds, these households, we see the government, these are firms and households. Then we see um, the role of government, and then the import export, the overseas sector. Something is withdrawn, something is injected. So injections and leakages, we see that would happen. Now, as part of that, there are certain things which are explained here in detail. What's the concept of consumption? So what is consumption? The spending by people. When people consume the products and services that are produced by the firms, then the firms will be able to generate revenue. So the spending by people or households on the circular flow model is termed as consumption. So we have the terms as MPC. MPC is the marginal propensity to consume. The spending by people or households on the circular flow model is termed as consumption. The single most important determinant of the level of consumption is the level of income. So how do they decide on the uh, what would be consumed? How much income is available with them? Okay, this is true for both individuals and the economy as a whole. Then it says that the extent to which consumption changes with income is termed as the marginal propensity to consume. Marginal, the term is with the change by one additional unit, that is marginal. Whenever we talk about it, marginal propensity to income is with the change in income, what is the change that happens in consumption. Marginal propensity to consumption is equal to change in consumption, that is delta C, divided by this consumption is happening on account of change in the income level. So income, more income is generated. Why more income is generated is because more injections happen into the circular flow of funds. So because of more injections, more consumption happens. So we see that more injections, more income is generated. Additional investment, additional income is generated. With additional income, additional consumption happens. Okay. There's an example given here. What are the factors that affect the consumption income, the wealth of it, government policy, um, the cost and availability of credit, and price expectations? Um, See here, the accelerator is given to us as growth in incomes result in growth in investment. Then the change in income because of change in investment, because of change in income, and the accelerator. The accelerated part of it is there is a multiplier. Multiplier is calculated as L multiplier is equal to 1 by MPS or 1 by 1 minus MPC. See, what is MPS? Marginal propensity to save, how much they would be saving. See, because now we see that because of withdrawals and injections happening into the circular flow of funds, more income is generated. So more consumption also happens. But apart from that, if they are um, propense to, or if they are looking at savings, so if they set aside a portion of the amount, then that would be spent on consumption. Okay, so what is marginal propensity to save? So how much, what's the balance of it after consuming that they would be saved? Or multiplier is calculated as 1 by marginal propensity to save or 1 by 1 minus marginal propensity to consume. So after consuming whatever is the balance, that would be saved. Okay, the rest of that will be taken for consumption. So when they consume, they are contributing towards generating revenue for the firms. The consumption part of it only will see when they consume the goods and services produced by the firm, they are contributing some income to the growth of the firm. So that's how firms grow. They produce more. Then these have to be consumed. See, just the firm produces goods and services is not sufficient. They in turn have to be uh, sold and they have to be consumed by the people in the economy, the households, individuals from the households have to consume. See, after saving how much they are consuming or after taking out what is the consumption, see, they are setting aside some portion of it. The balance of it only will be contributed towards the consumption. So take that multiplier, multiply it into the growth or change in the income. So that will be it will be multiplied into change in the investment. That will be changed into in the income. So income grows when whatever is invested into the portion of it which is uh, after removing the portion of saving, the portion of consumption. So that's how the level of income grows in an economy. We will start on this same note and then continue tomorrow as well, and then proceed further. So once again, I will explain about what is circular flow of funds.
Yes, ma'am.
Okay, and then we'll continue, and then aggregate demand and supply, other topics. So we can take it up, the other topics as well in tomorrow.
Okay, ma'am.
Okay.
Bye, ma'am. Thank you.
Okay, ma'am. Bye.